Welcome, day traders. You are watching a recap of the Asian session. Japanese and Australian stocks started the day with an increase. However, trading is likely to be rather volatile today, despite a good start. Let's discuss it in detail. A recent rally in the stock markets may help traders reap profits. However, upside potential is limited due to recession fears. For this reason, investors are flocking back to safe haven assets, namely the greenback and the US government bonds. Risk appetite weakened significantly after the release of a Goldman Sachs earnings report. One of the world's largest banks posted its worst earnings miss in a decade. Goldman said quarterly profit plunged to 66.3%. For comparison, Morgan Stanley shot about 40%. However, investors considered this result positive as it exceeded expectations. The VIX index reflects the level of market fear of uncertainty. On January 17, it fell to a 10-month low of 19.2 for the first time since April 2020. The more the index declines below the 20 level, the less the level of anxiety is. It means that stocks are steadily growing. A decline in the VIX may signal a good opportunity for purchases. As seen, there is no panic in stock markets before the release of the US Producer Price Index and retail sales today. According to the FedWatch Tool, nearly 94.2% of investors are betting on a softer stance of the Fed. They are factoring in a 25 basis point rate hike in February. It caused a new drop in the yield of US government bonds. Dollar bills are also unable to regain ground. Yet the US dollar, as a safe haven currency, is rising amid growing concerns about a deeper global economic downturn. The greenback entered the range of 102.40 and 102.90 due to mixed fundamental factors and the head of economic reports. In the Asian session, it was trading at 102.50 versus its main rivals. Apart from the other reasons, it managed to climb thanks to a decrease in the yen. The yen weakened by more than 2% following the Bank of Japan's meeting. The regulator disappointed investors. The Bank of Japan kept intact its yield curve control targets, set at minus 0.1% for the short-term interest rates and around 0% for the 10-year yield. The central bank also made no change to its guidance that allows the 10-year yield to move 50 basis points from its 0% target. It also stressed that it did not intend to revise the yield control policy. Nevertheless, analysts still believe that the regulator is preparing the ground for a policy reversal in June or even earlier in April. In 3 months, Haruhiko Kuroda is likely to leave the office. It will indicate the end of the monetary easing era, which has been lasting for 10 years. However, the Bank of Japan remains ultra dovish compared to the other central banks. It assumes that a high inflation may help stabilize prices and boost wages. As import prices are growing and the standard of living in Japan is declining, wage growth could improve the economic situation. The standard of living has decreased mainly because of the depreciation of the yen versus the US dollar. Traders got extremely disappointed with the Bank of Japan rate decision, so the yen began to fall rapidly. It was trading at 130.20 in the Asian session. Due to the dovish remarks, the dollar-yen pair logged the biggest daily jump in 7 months. To understand why the yen has slipped so rapidly today, we need to recall the events of December. Back then, the central bank made a hawkish move by widening the target range for its 10-year government bond yield. Market interpreted this step as an interlude to the policy reversal. However, after the discouraging results of the January meeting, the yen lost momentum. The dollar-yen pair returned to the former support levels of 130.40 and 131.70, and they could turn into resistance. In the short term, the Japanese currency is likely to be quite weak. During the Asian session, the pair advanced to the price corridor of 128.10 and 131.60. Traders are now more focused on external factors, so the pair may slightly decline amid softer US data. The Australian dollar managed to rise in the morning ahead of the US market starts. Its growth was also bolstered by the expectations of the Reserve Bank of Australia's rate decision. Besides, it's up amid optimism about the quick recovery of the Chinese economy. The People's Bank of China continues to inject money into the market. There is a boom in sales and traveling ahead of the Chinese New Year. China has opened up after 3 years of lockdowns, and many families want to finally celebrate this holiday together, according to a tradition. So the yen is rising amid improving demand in the world's second largest economy, and this is also bullish for the Australian dollar. In the Asian session, the AUD-USD pair grew to the range of 0.6974 and 0.7037. Nevertheless, the Aussie remains vulnerable to the dynamic of the US dollar. The pair was hovering near the intraday low of 0.7027. Following an increase in demand for the US dollar, bulls need to push the pair above the pivot resistance level of 0.70. Traders are now also anticipating Australia's employment data. And this report is on a tap tomorrow. Today, speculators are looking forward to crucial US economic data. It will be released at the start of the American session. It may cause sharp price swings. And that's all for now. Thanks for watching. Subscribe to our channel and stay up to date with the latest market news. See you soon.